Welcome to another Founder Wisdom Pod. We have Sean Nasiri with us today. He is a VC and an investor at JAS Ventures, so JAS Venture. He started that company, I believe, in 2021. Before that, Sean, you were a mentor, you were a venture advisor, studied at Columbia, I believe, started in sales. Is that a good description of yours?
So far, so good.
Tell me a bit more about what I missed there and what you're up to nowadays.
Yeah, so I guess my professional background has kind of always been at the intersection of entrepreneurship and venture capital. So I was born and raised in Silicon Valley, so naturally, as any kid, I couldn't wait to get out. And once I finally did, Silicon Valley kind of followed me and took over the world, so to speak. So yeah, I went down to school at USC. And I would say about halfway through, like around 2009 or 10, was kind of when the silly app craze took over the country and the world to a degree, where you didn't need to have a business or revenues. You just needed to have daily active users and downloads to go out and raise like 20 mil. So naturally, everybody wanted to be an entrepreneur. So it was like I just left Silicon Valley, but now all of a sudden, being from there presented a lot of value. And the short version of it is, I got involved with a lot of student-run ventures. I then, in 2013, a couple of years after graduating, I was with the Jobs Act who just passed. I ended up launching one of the first equity crowdfunding platforms, allowing me to take what I was doing with vetting and working with founders and connecting them with a network of investors and leveraging a new legislation and an online platform to do so. I then launched the first Regulation A plus equity crowdfunding platform as director of investments at StartEngine. You might see their commercials on CNBC and stuff. Fast forward, I end up switching coasts, moving out to New York City, where I helped build Newark, New Jersey's first social impact incubator co-working space. Fell in love with New York, did not fall in love with Newark. No offense if anyone's listening from Newark. But yeah, dabbled around New York with sort of hospitality, media, fashion. Again, trying to escape tech before eventually falling back into it. So I then was head of business development and expansion and operations at a company called Tokensoft, which was leveraging blockchain technology. I kind of call it the 2.0 to what equity crowdfunding did to tokenize real world assets and equity. So now if you own a piece of a painting or a piece of real estate, or you have seed shares of a startup, you're generally locked in for 5, 6, 7, 8 years. Whereas with tokenization, you can freely trade everything like you would, in theory, a publicly traded company. Just makes it more liquid and you can do sort of global fundraisers. And then, yes, in March of 2021, we started J.A.S Ventures. It's essentially a family office from the Middle East, from Abu Dhabi. I met the son while at undergrad and nurtured the relationship for nearly a decade. We've gone on to do 16 investments and taken LP positions in 5 funds.
Interesting. And you keep mentioning that you left tech, you left the West Coast to go to the East Coast. Why is that? Because most people would do the other way around. Like New York is quite stressful. I think AI is at the epicenter of SF. There's amazing stuff going on the West Coast. So why do you keep mentioning that you left that world?
Yeah. So interesting question right there. I think, I guess it depends, right? Because a lot of am I frozen? Okay, we're back.
Yeah, you're back. Sort of frozen, but we hear you.
Okay, cool. That's fine. So, I think a lot of people do end up moving back to Silicon Valley after college. I think I always just had a bigger aspirations of wanting to see the world and wanting to experience as much as I can. So all I wanted to do was leave. But I think you're correct. Silicon Valley is very much the center of the tech world again, with the whole AI, hard tech, deep tech, robotics boom. I think there was a point leading up to COVID, which was then accelerated by COVID, where tech companies were starting to be more distributed as everything was more just kind of like enterprise SaaS. New York was growing well, the Europe, Middle East, LATAM. And then with COVID, when you kind of created like remote first workplaces, and given the quality of life in the Bay Area during COVID, a lot of people left. But then I would say, probably a year and a half ago, once AI, ML, and advanced technologies became sort of the focal point of venture, the center of the universe kind of came right back, or not the universe, but the startup world came back to Silicon Valley and sort of very firmly established itself there.
Interesting.
But I still go back every 4 to 6 weeks.
Right. And you founded one company. Were you successful as a founder, or did you switch directly to the VC world? And if so, why?
Okay. Tougher question. So I would say Generator, which was the equity crowdfunding platform I started after college, was successful, but it was not without its faults and issues. So we built out a great team. We were working right on USC's campus, working within the confines of the program. Did a lot of other side things that kind of detracted from there, but built out a team of 15 people. We sort of achieved our proof of concept, but then ultimately had to sort of close down the business and sell it for parts, so to speak, due to some internal issues. Also concurrently, while I was going through my network of advisors and mentors and asking them, how should I play this out? One of them, which was at StartEngine, was like, well, listen, we're launching a platform soon. This is a young man's game. Why don't you come be our director of investments? Like, you're making some money off the sale. Come launch this for us. We'll take care of all the overhead and the fundraising, and you take care of the companies.
And yeah, you became director of investment at StartEngine, which is a great company, by the way.
Yep.
I had Hive, the CEO of Hive, on my podcast. Sim Desai, which is a total beast.
Nice.
So what happened at StartEngine? You worked there 1 year. You were director of investment. You learned from your experience then, and then you started your own portfolio of company, your own investment fund, sort of.
Yeah, so concurrently while at StartEngine, I started doing some angel investing as well, putting sort of my mouth where my money is, and instead of investing other people's money, was starting to invest my own. StartEngine had a lot of things going for it, but I think the culture was off, and I'll just kind of leave it at that, because I do think they're a good company and there's good people working there, but me having to close my business prematurely. I was very sensitive to sort of the cultural dynamics, and again, I just kind of had greater aspirations again. So one of my early, actually my very first angel investment, was growing very quickly, so I wanted to get more involved with them, and then concurrently, one of my other good friends who I was getting close, not a good friend, but somebody I'd met and I was becoming a very close friend of mine, was working on this project in Newark, New Jersey. So now I had this unique opportunity to work hands-on with a high-growth startup. We'd raised money from Tim Draper and Salesforce CEO Mark Benioff, and the company was really taking off. And at the other time, I had access to a friend who just sold his company for a great amount of money. I had access to his penthouse and a free place to stay in New York, and had a chance to go out on the East Coast. So I kind of took that and ran with it.
Right. And your angel investments, was that cash that you made from your past jobs, for example? Like, how did you get that money to angel invest?
Yep. I was very active and very ambitious when I was younger. Not to say I'm not now, but it was just a different sort of. I would say, like, ignorance is bliss, right? You don't know what you don't know, and you thought you knew everything back then. So I was making a ton of money with more or less dumb luck investing in the public markets, and was overly actively trading, but got lucky that I didn't get burned and I made a good amount of money. While in college, while working with a handful of student-run ventures and helping connect them with VC funds, I was also building Motorola's university relations program, due to a couple situations. I ended up kind of building it hand in hand with the person who was running it when I was just meant to be a campus rep. But then I was positioned as kind of Motorola's go-to person for all things, college student related. So I was making good money working 20 hours a week for Motorola, talking to executives there, working on university relations stuff. I had my hands in a couple of startups, and I was making good money in the market. And then with the sale of my company, Generator, I had some cash to also be able to do some things.
Right. And you had a couple of very successful investment, I guess, with JAS, including MoonPay. I see Yuga here. I see Republic. What was the check size on these, and what were your precise return up to this day? And did you cash out yet?
So let's work backwards. Have we cashed out yet? No. There's been very few exits. So DPI for any fund that was around 2021 has basically been zero across the board. But we are optimistic that there's going to be more IPOs and M&A this year. And once sort of the first domino falls, I think we'll see a nice, strong, healthy market. We're not going to see the bull run of like 2021, 2022 with a bunch of really silly companies that had no business going public raising money. But I think there's still some good upside. In regards to the companies that we did invest in, I would say our average ticket size, almost probably 75 to 80% of our checks were 500K. In terms of the companies you mentioned, yes, we're very proud to be in, MoonPay, which, Ivan, I met and spoke at one of his conferences. And I remember when, he was trying to go out and raise money for it, maybe 6, 7 years ago now, and couldn't raise any money. And then next thing you know, he bootstrapped it while concurrently running like a crypto network of talks and hosting events. And then boom, next thing you know, it's $100 million a year ARR business, which is super impressive. And then I would say actually our two best performing companies and two hottest ones are the two you didn't mention. So one is Armada. Armada is a mobile edge computing as a service company. They have a stellar team, stellar product. The company was essentially incepted by like the CTO of Starlink, and then was put together by, let's just call it the Peter Thiel Mafia, who sort of seeded it. So you have like 137 Founders Fund, 8VC and Lux Capital. And we were able to come in on the friends and family round. They've since gone on to raise money from Valor, Felices, kind of more strategics. And then M12 preempted them last year at kind of like a 3x of where we invested. And now they're about to finalize a round that should put them in unicorn status, at least on paper. Radar is another company that we've been close with for a very long time. They've sort of been around for a bit. The founder was a former Thiel fellow, former Y Combinator, two-time college dropout. And he developed a product that basically, it's a hardware device that basically allows retailers to have up to the second, up to the minute accuracy of every item in their store. Most retailers are lucky to have 50% inventory accuracy. And if you scale this out, I believe Target said they lose between $600 to $800 million a year due to inventory inaccuracy. So that's one part, like missed sales opportunities. Hey, this product said it's here, but it's not. Or somebody says they want something and the system says it's not, but it is. The other part, just it makes it really tough to forecast and plan when you only have 40 to 60% accuracy range. So this company, their average contract moving forward is going to be like 3 mil, close to 3 years, close to 100 mil a year type of contract. So they're working with the biggest retailers in the world. They just signed a deal with Old Navy. They've been in pilot with American Eagle for a couple of years, and everybody from Nike and Foot Locker to Nordstrom and Macy's and H&M and Uniqlo are in their pipeline.
Interesting. And you mentioned family office. So who's involved in that one? Is who in your family precisely, and why Dubai?
So the family that I work for, whose son I've known since undergrad, is based out of Abu Dhabi. Um, they like to fly a bit under the radar, given the father's position within the government. Um, but yeah, I'll just kind of leave it at that.
Okay, so the company's registered there. Does that help in investing in crypto companies as the crypto compliance and regulatory system is lighter in Dubai, for example?
I guess in theory it would. We don't really do crypto per se. Like I view MoonPay as a fintech company. They're sort of the off and on ramp between Web 2 and Web 3. They have a bunch of money transmitter licenses. So I view them as a fintech company in Web 3, Web 2, Web 3. And then Yuga I view as a media and gaming company. So both companies might have been birthed out of crypto, but they're not trading cryptocurrency. I mean, they don't have, it's not like they have their own coin. That's where crypto companies are getting in trouble. And as somebody who was working at a company that launched some of the biggest regulated ICOs, we called them FTOs at the time. Um, I still I still have a tough time wrapping my head around the alignment and the savoriness of companies, launching tokens before they've even started developing a platform and making money off those tokens before a product is released. I think it's a misalignment of long-term incentives. Now, I do think there's value to like having ownership over a protocol layer, but it should be earned. And I don't think it should be traded like it is, especially given the manipulation. So that's when companies are getting in trouble with the SEC. It's not companies like Yuga and MoonPay.
Right. Yeah. And what is this? Like 80% of crypto projects nowadays are that style. I call them rug pull. And ironically, I think there's a lot of VCs that profited off that, right? Like there's a lot of VCs that make big money fast in the crypto heydays, probably, let's call it 2016 to 2020. And even nowadays, you can't say that think the laws are clear, right? I think it's moving too quick for the SEC, but yeah, interesting stuff. I checked out your Instagram. You seem to have a pretty fun life, pretty relaxed life. Is that like the VC life? You just invest and enjoy the world and get insights. Tell me a bit more about your day today.
Yeah, I tried to make my Instagram not searchable. My last name's not on it, but I guess you got some skills. But I would say it's important to sort of do what you love, right? So, I would say Friday to Saturday, Fridays and Saturdays, I'm very active. Monday, Tuesday, Thursdays, I'm working, 8 to 12 hours. And then, if any of my founders ever need me and anytime, anywhere, I'm always there for them. Um, but yeah, I would say I think it's important to enjoy life and however you enjoy it. I mean, I know plenty of people who don't want to. Their idea of free time is stepping away from the office and spending some time with their family or going to local hiking trails or bike rides. So it's what everybody likes. I really enjoy good food and I really enjoy travel. I will say, being in the VC world, you are sort of allotted a bit more flexibility in terms of how you want to manage your schedule. You work as hard as you want. You put in you get out what you put in. Um, so like you do have a bit more leeway, and people do like to joke. After Thanksgiving, through New Year's, most VCs are off on holiday at the beach, and then
A lot of
from like
friends.
late Memorial Day to Labor Day, they're all in Europe. Um, I personally say a lot of us are still working. I'm still always available for meetings and phone calls. I'm not sort of cutting my calendar short like some more senior people do. So I think it depends where you are in your career, but there's a lot of conferences that tend to be piggybacked around cool events in cool parts of the world, which I think is probably on purpose as a draw to help you know get certain founders and certain investors over the edge. But I will say I do think it's funny when I do see my founders who are sort of traveling a healthy amount or going to sort of the same places that I go to on holiday. I'm like, huh. Uh, looking at my emails, I don't see any updates on closing a new mega deal, but I guess we're celebrating something. But I think it's however you want to balance your life. You can always make time to do stuff that you love and for having fun and exploring the world.
Yeah, because in the end, as a VC, depends on your deal flow. So how many decks you're evaluating, how many companies you're analyzing, and how many current companies you're having in your portfolio to quote unquote coach. And yeah, I guess the more time that you put in, the better your investment. But recovery is also important, right? So that all this information can consolidate and you can make great investment decisions. Talking about that, how do you make yours? How do you analyze a company? Do you deep research them on ChatGPT and go with fancy reports? And how do you evaluate the founder fit to the product that they're building?
Amazing question. What I love about VC is I have crazy ADHD, and VC allows me to learn about new industries, technologies, pain points, problems, bottlenecks every single day. And that's what keeps me on my toes. I am incredibly intellectually curious. I'm a deep research junkie, and I know an industry is something I want to pursue. If next thing I know, I just finished dinner, and next thing I know, it's like 6 a.m. and I'm like, shoot, I got 3 hours to sleep before my next call. That's when I know that I'm down the right path. When what the problem or the industry or the technology that they're working on has me excited to the point where I just go down the rabbit hole and I come back up for air and I'm like, wow, it's just been 8 hours I've spent working on this. So that's part one. I would also say, because somebody asked me this in a recent question, and I should touch on it, is I've I've worked hard to develop a good network, and anytime you dive into a new industry, it gives you an excuse to either tap into your network or expand your network by finding experts in that industry. Another thing I like to do is if I find the industry is bigger than just like a pain point, is talking to multiple companies and founders within the space because they know their tech and they know their industry inside and out. I have an article on LinkedIn about it, but the company I mentioned, Radar, that does the retail technology, I found them on accident. I was doing a deep dive at a thesis around sort of autonomy, autonomous movements, not necessarily autonomous, on the road vehicles, but farming, back of house sort of stuff too. And I went home to the Bay Area and I went up and down 280 and I spoke to like 4 to 5 different PhDs, and I always asked them about the tech stack. And RFID is kind of like the bastard cousin to like LiDAR, like the early foundation of which is essentially all just radar technology anyways. And they all said what Spencer is doing with RFID is impossible. They were like, RFID is not good for precision. It's not good for location accuracy, and it doesn't work well if you have a lot of RFID devices in the same room. Spencer's proved that wrong 100 times over. And then the part two of your question around the founders. Um, I would say I have a pretty good instinct for people. Like you saw, when I travel, sure, I'll see some sites, but I feel like the sites are the sites because they've been there for hundreds of years, in some cases thousands, and they'll remain there. What I like to do is I like to get connected with my peers in that country, in that city, and I like to put myself in their shoes, and how would life be if I was them and I grew up here, and to just meet strangers and be able to go out with them and spend weekends or weeks with them, take some pretty good people instincts. And I would also say I have the deal velocity, right? So with the equity crowdfunding platforms, within like my personal life, just kind of being so adjacent and enthralled within the startup community, uh, I've been looking at probably 200 deals a year on average for the past 10 years. So when you're around it and you've had the velocity and you're meeting hundreds of founders a year, you learn to figure out what traits and what qualities stand out. And then when you've been in it for long enough, you have the wherewithal to be able to look back and be like, was my instinct right? You know, did I totally miss it on a company? Like, oh yeah, this kid has no chance. And then 4 years later, they take a company public. Or man, I think this kid has the X factor, but his company goes belly up in 8 months. So you kind of learn that only by being in it. Um, and you need to have good instincts about people. Like until Series C and D, it's so much of a people game. You have to know the questions to ask. You have to get them talking, but at the same time, you have to throw them off their guard and see how they do.
Got it. Thank you so much for the value today, Sean. Where can people find out more about you?
I used to say go on my Twitter, but I've had an impossible time gaining a following there. My Instagram is it's purely personal and leisure. It's has no business activity. I'm doing everything on LinkedIn these days. I'm trying to become as active as I can on LinkedIn to do like a medium format article and posts. So please find me on LinkedIn and happy to chat. And like my stories and stuff when you see them, please. I need to get that going.
All right. So that was Sean Nasiri and Charles Cormier for